Let's look at the major trends impacting the asset management industry today. Shift from active to passive funds. In 1975, a man named Jack Bogle started the first index fund. His fund's holdings simply mirrored the composition of the S&P 500 index. There was no elaborate stock-picking strategy. Bogle's index fund investors gained access to a diversified portfolio and market-level returns, but at a very low cost. Even though Bogle's fund raised only $11 million, it sparked a movement in investment strategy, from active to passive investing, a shift which continues today. In 2007, roughly 30 years after Bogle launched his first index fund, the share of U.S. equity funds that were passively managed reached 20%. Today, thanks to the soaring popularity of passive investing, nearly half of U.S. equity funds are passive. And the company that Bogle founded, Vanguard, is the second largest asset management company in the world, with over $5 trillion in assets under management. As passive funds gained traction, traditional asset management firms introduced their own passive funds that attracted significant investor capital. Some of these funds, specifically those managed by Blackrock, Vanguard, State Street, and Fidelity, were wildly successful. So, can the high growth of passive funds continue indefinitely? Some experts believe that having such a large portion of global AUM in passive funds poses a systemic risk to markets. Just think of this hypothetical scenario. If all stocks were owned by passive funds, stock prices of all companies would increase and decrease together, no matter how well or poorly the company performed. There would not be any active managers who evaluate individual companies and send signals to the market about their performance. However, many other experts think we are far from that point, and passive funds will continue their growth trajectory.